One of the most iconic financial showdowns in recent history, the GameStop short squeeze of 2021, saw an army of Redditors and retail investors challenge Wall Street hedge funds giants and won. Welcome to Do Academy. In this video, we'll explore the dramatic twists and turns of this extraordinary event and delve into the enduring effects it had on retail investors and market dynamics. Our story begins with struggling video game retailer GameStop, which first opened its doors back in 1984. It initially started with video game sales starting with Atari 2600 titles and then grew with Nintendo games when it entered the market in 1987. Fast forward to February 2002, GameStop went public on the New York Stock Exchange with an IPO of $18 per share. Through a series of mergers and acquisitions, GameStop transformed from a small store selling video games and consoles into a massive retail chain with over 5,000 stores worldwide. Despite the increasing shift towards digital gaming, GameStop stuck with its brick-and-mortar approach. But trouble began in 2016 when they couldn't keep up with the rise of digital game downloads from companies like Xbox and PlayStation. In 2017, GameStop faced a significant drop in sales and declining stock price. To cope, they announced store closures, diversified its products, and even looked for a buyer. Despite efforts to rebrand itself as a competitive and retro gaming hub, GameStop still struggled to meet revenue expectations. But suddenly, in 2020, the gaming industry boomed due to the COVID-19 pandemic. This led to a surge in GameStop shares and set the stage for the stock market saga that would ensue the following year. Like a true underdog story, GameStop got its second win in 2020 and things started to look better for the retailer. While fans rooted for GameStop, Wall Street hedge funds decided it was a good idea to short sell its stock for profit in 2021. Short selling or going short is the opposite of going long, where investors buy a stock and hope for the price to go up. Short sellers, on the other hand, are betting for the stock price to go down in order to profit. This involves borrowing shares of a stock and selling them at the current market price. The aim is to buy it back later at a lower price when it's time to return the stock and profit from the difference. Unlike going long, where the maximum loss you can incur is the initial investment amount, short selling involves borrowing costs and has unlimited loss potential. It's a strategy often used by experienced traders and investors with a high tolerance for risk. Now that we've gotten that out of the way, let's get back to our story. So, back to early 2021, a community of retail investors on Reddit known as WallStreetBets noticed something unusual. GameStop's stock price was heavily shorted by the hedge fund, with more shares borrowed than existed. This set the stage for an explosive financial showdown. This Reddit community saw an opportunity and began buying GameStop shares, driving up the stock's price. What started as a David and Goliath battle soon gained momentum as everyday retail investors across the world joined the cause. In just over 6 months, GameStop's stock price skyrocketed by somewhere around 8,000%. Even the big names started getting in on the action. Venture capitalist and founder of VC firm Social Capital, Chaman Palihapitia, tweeted that he was buying GameStop calls. Elon Musk further escalated the hype when he tweeted GameStonk with a link to the WallStreetBets subreddit. The massive buying frenzy of GameStop shares led to a short squeeze, where the hedge funds betting against GameStop faced mounting losses and were forced to cover their positions by buying the stock at a much higher price. This in turn pushed the stock price even higher, creating a challenging situation for those betting against it. Short sellers lost an estimated $23.6 billion in this rally. Melvin Capital Management, a hedge fund betting against GameStop, was down 53% in January 2021. It had to call in help and eventually gave up its bet on GameStop. Facing tremendous scrutiny from the online community, Citron Research, run by famous short seller Andrew Left, announced that his company would stop publishing short reports, ending a practice it has held for 20 years. The hedge fund losses sparked calls from Wall Street to ban short selling, even though it's a common practice used by many traders. To prevent a stock market crash, trading app Robinhood restricted the purchase of GameStop on their platform. This caused major backlash with accusations of market manipulation by the wealthy. Several members of the US Congress also voiced concerns of unfair play. The GameStop saga marked a significant victory for retail investors, demonstrating their growing influence on financial markets through social media and online forums. Never has a group of amateur investors taken on hedge funds like this and won. This newfound collective power boosted retail participation in the stock market, although some faced losses as GameStop stock price normalized, emphasizing the importance of informed trading. As for WallStreetBets, it appeared that the community has fine-tuned its short squeeze strategy, focusing on heavily shorted stocks like AMC, BlackBerry, and Tootsie Roll. However, restrictions on trading these volatile stocks by platforms like Robinhood sparked criticism, with claims of favoritism towards hedge funds and institutions. The GameStop saga left a lasting impact on market dynamics, triggering increased scrutiny of short selling and market regulation. Some even see it as a reckoning for Wall Street power players. US Senator Elizabeth Warren emphasized that hedge funds and wealthy investors treated the stock market like a casino, leaving others to bear the brunt. She pushed for the SEC and regulators to step up. Regulators and lawmakers began exploring stricter oversight of short selling to prevent manipulation and the role of social media in market volatility. This event also sparked discussions about the importance of financial education for retail investors, highlighting the need for better understanding of the risks and rewards in volatile markets. Fast forward to October 2022, GameStop stock hit its lowest point since February 2021, down nearly 90% from its peak, but still 3 times higher than its pre-social media hype. The GameStop short squeeze of 2021 showcased retail investors' collective power and revealed market complexities, offering opportunities while emphasizing speculative trading risks. It also sparked scrutiny of short selling and discussions on market regulation. Looking ahead, the GameStop saga reminds us of the ever-changing financial landscape, underscoring the importance of staying informed and cautious in markets. Now, what are your thoughts on short selling? Is it a viable investment strategy or a practice requiring tighter regulation to prevent market manipulation? Share your thoughts in the comment section below. Be sure to like, share, and follow Do Academy for more actionable investment insights.